You know what's fascinating? Right now, in the gold market, something is happening that most people will never hear about on CNBC. It's a technical signal so rare, so historically significant, that the last time we saw it persist like this, physical gold became nearly impossible to buy at any price. I'm talking about gold backwardation. And if you understand what I'm about to show you, you'll see why some of the smartest money in the world is moving with extreme urgency right now. Let me paint you a picture of how gold trading is supposed to work. Under normal market conditions, gold for delivery today costs less than gold for delivery 6 months from now. Makes sense, right? If I'm selling you gold I have to store for 6 months, insure it, finance it. I'm going to charge you more than if you take it off my hands today. This price difference, this premium for future delivery, is called contango. It's the natural state of commodity markets. It's how things should be. But here's where it gets interesting. Sometimes, this relationship inverts. Suddenly, gold for immediate delivery costs more than gold for future delivery. The market is literally telling you that people want physical metal in their hands right now so badly, they're willing to pay a premium over waiting. This inversion, this backwards pricing structure, is called backwardation. And when gold goes into backwardation, it's not just a technical curiosity. It's a warning signal that physical supply is getting tight. Now, I need you to understand something crucial here. Gold backwardation isn't common. For most of modern financial history, it was considered theoretically impossible. The textbook said it couldn't happen because gold is the ultimate liquid asset, the most widely held reserve, stored in vaults around the world. If spot gold ever traded at a premium to futures, arbitrageurs would immediately sell spot, buy futures, and pocket the difference. The market would correct itself in minutes. Except that's not what's been happening. Starting in 2008, we began seeing brief episodes of gold backwardation. A day here, a few days there. The market would notice, correct, and move on. But pay attention to this, because the pattern has been changing. These episodes have been getting longer, more frequent, more persistent, and the premiums have been getting larger. Let me take you back to December 2008. Lehman Brothers had just collapsed. The financial system was in free fall, and for the first time in modern history, gold went into backwardation. Not for a few hours, for days. The spot price of gold was trading above the futures price, and it stayed that way even as arbitrageurs tried to correct it. You know what that told us? It told us that people with gold in their possession didn't want to sell it, at any price. They didn't trust the system enough to let go of their physical metal, even for a guaranteed profit. Fast forward to 2013. We saw it again. This time, during the great gold price smash, when paper gold got hammered down from $1,900 to $1,200. But here's what the mainstream media missed while they were writing gold's obituary. Even as the paper price was collapsing, physical gold went into backwardation. The futures were trading below spot. Coin dealers were running out of inventory. Mints couldn't keep up with demand. The Perth Mint, the US Mint, they were all rationing sales. What was happening? The paper price was saying gold was worthless, but the physical market was screaming shortage. Now here's where we are today, and this is what you need to pay attention to. We're seeing backwardation signals that are more persistent and more widespread than anything we've witnessed before. I'm not talking about brief technical glitches. I'm talking about sustained periods where the spot price is trading at a premium to near-term futures, where the cost of immediate delivery is higher than waiting, where the market structure itself is telling you that physical metal is becoming harder to source. Let me show you what this looks like in practice. Go look at the gold lease rates right now. The lease rate is essentially the cost of borrowing gold. Under normal conditions, it's positive. Someone who owns gold can lend it out and earn a small return, just like lending out dollars. But when lease rates go negative, when they go into backwardation, it means people are willing to pay for the privilege of holding physical gold. They're not earning a return. They're paying a cost. Why would anyone do that? Because they believe the alternative, not having physical gold, is more expensive. And we're seeing negative lease rates persist across multiple time frames right now. The 1-month lease rate, the 3-month, even the 6-month, they're all showing signs of stress. This isn't a one-day anomaly. This is a structural shift in how the market is pricing physical versus paper gold. But here's what makes this even more significant. Look at what's happening in the physical delivery markets. The COMEX, the major futures exchange where gold trades in New York, has been seeing something remarkable. The amount of gold standing for delivery, meaning people who are actually taking physical metal instead of rolling their contracts forward, has been surging. In a normal month, maybe 5% of contracts stand for delivery. Most traders are just speculating on price. They don't want the actual metal. But we've been seeing months where 20, 30, even 40% of contracts are demanding physical delivery. You know what that means? It means the paper gold market, the market where most price discovery happens, is starting to converge with the physical market. And the physical market is saying, we don't have enough gold to satisfy demand at these prices. Let me tell you about what happened in March 2020, because this is a perfect case study in what backwardation predicts. When COVID hit and the world locked down, gold futures in New York went into severe backwardation against London spot prices. The April futures contract was trading $70 below the spot price in London. $70. That's not a rounding error. That's a massive dislocation. What was happening? The gold that backs the COMEX futures contracts is stored in New York. The gold that trades in London is stored in London. And suddenly, with planes grounded and logistics frozen, you couldn't easily move gold from London to New York to make delivery against those futures contracts. The market was pricing in a physical shortage. Not a shortage of gold in the world, but a shortage of gold in the right place at the right time. And you know what happened next? Gold went from $1,500 to $2,070 in 5 months. The backwardation signal predicted the shortage, and the shortage drove the price surge. Now, I want you to think about what's different today. In March 2020, the backwardation was caused by a temporary logistics problem. Planes would fly again. Gold would move. The dislocation would resolve. But what we're seeing now isn't a logistics problem. It's a structural supply problem. Look at the data from the World Gold Council. Global gold mine production peaked in 2018 at about 3,300 tons per year. Since then, it's been flat to declining. We're not finding major new gold deposits. The easy gold has been mined. Every ounce that comes out of the ground now is more expensive, deeper, lower grade, harder to extract. The supply side is constrained. Meanwhile, demand is exploding. Central banks bought over 1,000 tons of gold in 2022, another 1,000 tons in 2023. They're on pace to buy another 1,000 tons this year. That's 3 years of record central bank buying. China, Russia, India, Turkey, Poland, they're all accumulating. And they're not buying paper gold. They're taking physical delivery and storing it in their own vaults. Then you have the Asian markets. China and India together account for more than half of global physical gold demand. The Shanghai Gold Exchange, where Chinese buyers trade, consistently shows a premium over London prices. That premium, that willingness to pay more for gold delivered in Shanghai, is another form of backwardation. It's telling you that physical gold in Asia is worth more than physical gold in the West. And here's the kicker. The Chinese government recently removed restrictions on gold imports. They're making it easier for Chinese citizens to buy gold. You know what that means? It means hundreds of millions of people who are already culturally predisposed to own gold, who have been saving at record rates, who don't trust their property market or their stock market, now have easier access to physical gold. That's not a marginal increase in demand. That's a structural shift. So let's connect the dots. You have constrained supply. You have surging central bank demand. You have massive Asian demand. You have increasing COMEX delivery demands. You have persistent negative lease rates. You have recurring backwardation signals. What does all of this add up to? It adds up to a market that is fundamentally short physical gold. The paper market, the market where most trading happens, has written claims on far more gold than actually exists in deliverable form. As long as everyone is happy trading paper, as long as nobody asks for physical delivery, the system works. But the moment people start demanding physical metal, the moment they stop trusting the paper claims, you get a squeeze. And that's exactly what backwardation is predicting. It's predicting that the gap between paper claims and physical metal is going to become a problem. It's predicting that at some point, someone is going to ask for delivery, and the gold won't be there. Now let me talk about something that's relevant if you're thinking about your own financial security. If you're sitting on a significant retirement account, maybe $100,000 or more in a 401k or IRA, you might want to understand how gold IRAs work. I put together a free guide that covers exactly how you can get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. It walks through the whole process, the rules, the custodians, how it actually works. Worth checking out if that's something you're considering for wealth protection. But back to what's happening in the gold market, because this gets even more interesting when you look at the derivative structure. The gold market isn't just futures contracts, it's also a massive over-the-counter derivatives market. Banks and bullion dealers trade gold forwards, gold swaps, gold options, all kinds of synthetic gold exposure. And most of these contracts are cash settled. They don't involve physical delivery, they're just bets on the price. The Bank for International Settlements estimates there are over $500 billion in notional gold derivatives outstanding. That's roughly 8,000 tons of gold equivalent. Compare that to the roughly 3,000 tons of gold that trade physically each year. You see the problem? The paper market is multiple times larger than the physical market. And here's what makes backwardation so dangerous in this context. When gold goes into backwardation, it's a signal that the paper market and the physical market are starting to diverge. The paper market might say gold is worth $2,000 an ounce, but if you actually want physical gold in your hands today, you might have to pay $2,050. That $50 spread, that backwardation premium, is the market telling you that paper and physical are not the same thing. Now imagine you're a bank that has sold gold derivatives. You've promised to deliver gold, or pay the cash equivalent, to your counterparties. You've hedged your exposure by buying futures contracts. Everything is fine as long as futures and physical trade at the same price. But what happens when they don't? What happens when backwardation persists and widens? Suddenly your hedge doesn't work anymore. You're exposed to the spread between paper and physical. This is what happened to some banks in March 2020. They were short physical gold and long futures, expecting the two to converge. But when backwardation hit $70, they were losing money on every ounce. Some of them had to scramble to source physical gold at any price to cover their positions. That scrambling, that panic buying of physical metal, is what drove gold from $1,500 to $2,070. And we're seeing the early signs of this dynamic playing out again. Look at the COMEX warehouse stocks. The amount of gold sitting in COMEX warehouses available for delivery has been declining. We're down to around 20 million ounces of registered gold that's actually available to deliver against contracts. That sounds like a lot, until you realize that open interest in COMEX gold futures represents over 40 million ounces. The paper claims are twice the available physical gold. Now, most of those contracts will never stand for delivery. Most traders will roll their positions forward or close them out for cash. But what if they don't? What if even 10% of those contracts demand physical delivery? You'd need 4 million ounces. You only have 20 million ounces in the warehouse. That's fine. You can handle it. But what if it's 20%? 30%? At some point, you run out of gold. And that's exactly what backwardation is predicting. It's predicting that the demand for physical delivery is going to exceed the available supply. It's predicting a squeeze. Let me tell you about what happened in the silver market in 2011, because silver is gold's little brother, and the same dynamics apply. In early 2011, silver went into backwardation. The spot price was trading above the futures price. Lease rates went negative. And you know what happened? Silver went from $30 to $50 in 2 months. It nearly doubled because the physical market was tight and the paper market couldn't deliver. Now, silver came back down after that because the CME raised margin requirements and crushed the speculative longs. But here's the key point. The backwardation signal predicted the squeeze. It told you, weeks in advance, that physical silver was getting scarce and the price was going to spike. We're seeing the same setup in gold right now, but with one crucial difference. In 2011, the silver squeeze was driven by retail speculation. It was small investors buying silver coins in small bars. The big institutions weren't involved. But today's gold backwardation is being driven by central banks, by sovereign wealth funds, by institutional buyers who aren't going to panic sell when the price spikes. They're buying for strategic reasons, for monetary reasons, for geopolitical reasons. This isn't hot money. This is permanent demand. And that makes this backwardation signal even more significant. Because if the squeeze comes, if the physical shortage becomes acute, there's no easy way to resolve it. You can't just raise margin requirements and shake out the weak hands. The buyers are central banks. They don't have margin. They don't get liquidated. They just keep buying.
Think about what China is doing right now.
They've been reporting gold reserve increases every month for over a year. They're officially up to around 2,300 tons. But most analysts believe their actual holdings are much higher, probably over 4,000 tons. Why would they underreport? Because they don't want to drive the price up before they're finished accumulating. They're buying quietly, consistently, taking physical delivery and storing it in their own vaults. And they're not alone. Russia has been accumulating. India has been accumulating. Even countries like Poland and Hungary, countries that haven't bought gold in decades, are suddenly adding to their reserves. What do they all know that the average investor doesn't? They know that the dollar-based monetary system is under stress. They know that the U.S. has $35 trillion in debt and no plan to pay it back. They know that the Federal Reserve has expanded its balance sheet by trillions and can't shrink it without crashing the economy. They know that inflation is structural, not transitory. And they know that gold is the only asset with no counterparty risk, the only asset that can't be printed, the only asset that has maintained its purchasing power for thousands of years. So they're buying gold, physical gold, and they're taking delivery. And every ton they take out of the market is one less ton available for everyone else. Now let's talk about what happens when the shortage becomes obvious. Right now, backwardation is a technical signal that most people don't understand. It's buried in lease rates and futures spreads and COMEX warehouse reports. The average investor has no idea it's happening, but at some point, the shortage will become visible. Coin dealers will run out of inventory. Mints will ration sales. Premiums will spike. And that's when the real panic buying starts. I want you to imagine what happens when millions of people simultaneously realize that gold is scarce. Not scarce in the sense that it's rare, but scarce in the sense that you can't actually buy it at the quoted price. You see the price on your screen, $2,000 an ounce. But when you try to buy, the dealer says, "Sorry, we're out of stock." Or, "We have it, but the premium is $200 over spot." What do? You pay the premium. Because if you don't, someone else will. And then you'll have nothing.
This is what happened in 2008. This is what happened in 2013. This is what happened in 2020.
Every time gold went into backwardation, every time the physical market got tight, premiums spiked and availability disappeared. And every time, the people who already owned physical gold were protected. The people who were waiting to buy, who thought they could always get gold at the paper price, they were the ones who got caught. And here's the thing about shortages. They're self-reinforcing. The moment people perceive scarcity, they buy more, which creates more scarcity, which drives more buying. It's a feedback loop. And in the gold market, where supply is fixed and can't respond quickly to price signals, that feedback loop can get extreme. Think about oil. When oil prices spike, producers can drill more wells, increase production, bring new supply online. It takes time, but supply can respond to demand. But gold? You can't just decide to mine more gold. It takes 7 to 10 years to bring a new gold mine into production. The supply is what it is. If demand exceeds supply, the only way to balance the market is through price. And that's what backwardation is telling you. It's telling you that at current prices, demand exceeds supply. It's telling you that the price needs to go higher to ration the available gold. It's telling you that the people who understand this are willing to pay a premium for immediate delivery, because they know what's coming. Let me give you another historical parallel. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's dollars. What drove gold to that level? It wasn't just inflation. It was a loss of confidence in the dollar, a geopolitical crisis with Iran, and a physical shortage of gold. Coin dealers were rationing sales. The U.S. Mint suspended production of gold coins because they couldn't source enough blanks. The premium on physical gold over the paper price was enormous. And you know what preceded that spike? Backwardation. The gold lease rates went negative. The futures traded below spot. The market was screaming shortage, and the people who paid attention made fortunes. We're seeing the same signals now. But the fundamental backdrop is even more extreme. In 1980, the U.S. debt to GDP ratio was 30%. Today, it's 120%. In 1980, the Fed could raise interest rates to 20% to defend the dollar. Today, they can barely get to 5% without breaking something. In 1980, central banks were selling gold. Today, they're buying it at record pace. The setup for a gold shortage is more extreme than anything we've seen in modern history. And backwardation is the early warning signal. Now, I want to address something that skeptics always bring up. They say, look, gold has been in backwardation before and it didn't lead to a sustained price increase. 2013 is a perfect example. Gold went into backwardation, premiums spiked, but then the paper price kept falling. So why should we believe it's different this time? Here's the answer. In 2013, the backwardation was caused by a temporary surge in physical demand from Asia, while the paper market was being suppressed by massive short selling from Western banks. The physical shortage was real, but the paper market was bigger and more liquid, so the paper price won. But here's what's changed. The physical market is now much larger relative to the paper market. Central bank buying alone is absorbing nearly a third of annual mine production. Asian demand is structural, not cyclical. And the amount of gold available for delivery in the West is declining. The paper market is losing its dominance. And when the paper market loses dominance, backwardation doesn't just predict a temporary premium spike. It predicts a permanent repricing of gold. Think about what's happening with the BRICS nations. Brazil, Russia, India, China, South Africa. They're all talking about creating a gold-backed trade settlement system. They want to bypass the dollar for international trade and use gold as the neutral reserve asset. Now, whether this actually happens or not is debatable. But the fact that they're even discussing it tells you something important. It tells you that gold is being remonetized. It's moving from being just a commodity or a safe haven asset to being a monetary asset again. And if gold is being remonetized, if it's going back to being money, then the price has to be much higher. Because there's only about 200,000 tons of gold above ground. At $2,000 an ounce, that's about $13 trillion worth of gold. Compare that to the $100 trillion in global debt, the $300 trillion in global financial assets. If even a small fraction of that capital tries to move into gold, the price has to go exponentially higher. And backwardation is telling you that this process has already started. It's telling you that the smart money, the central banks, the sovereign wealth funds, they're already moving. They're already taking physical delivery. They're already preparing for a world where gold is money again. So what does all of this mean for you? It means that the backwardation signal is not just a technical curiosity. It's a warning. It's telling you that the gold market is under stress, that physical supply is getting tight, that the gap between paper and physical is widening, and that at some point, that gap is going to close violently. The people who own physical gold will be protected. The people who own paper gold, who own ETFs or futures or unallocated accounts, they're going to find out that their claims might not be worth what they think. And the people who don't own any gold at all, who are waiting for a pullback or a better entry point, they might find that when they finally decide to buy, the gold isn't there. This is not fear-mongering. This is pattern recognition. Every time gold has gone into sustained backwardation, a shortage has followed. Every time a shortage has developed, the price has spiked. And every time the price has spiked, the people who owned physical gold beforehand were the ones who benefited. The backwardation signal is flashing right now. The lease rates are negative. The COMEX delivery demands are surging. The warehouse stocks are declining. The central banks are buying. The Asian premiums are widening. All of the pieces are in place. The question is not whether a shortage is coming. The question is whether you're going to be positioned for it when it arrives. Because once the shortage becomes obvious, once the premiums spike and the availability disappears, it will be too late to act. The gold will be gone, and you'll be left holding dollars that are losing purchasing power by the day. The backwardation signal is giving you advance notice. It's giving you time to prepare. The question is, are you paying attention?